a bonded warehouse outside Rotterdam, surveillance cameras, motion-activated, pallets wrapped in shrink film, move along conveyor belts at 2:47 in the morning. Logged by barcode, not by name, the manifest shows industrial commodity transfer destination, undisclosed. Buyer, listed as a procurement subsidiary. The weight, 38 metric tons of refined silver, departed without press release, without parliamentary approval, without a line in any public budget. This is not unusual. It happens in Antwerp, in Singapore, in the bonded zones outside Shanghai. The paperwork is clean, the channels are licensed. What is absent is visibility. Meanwhile, the same week that shipment cleared customs, the government of the country that indirectly authorized it announced a public services freeze. Pension adjustments deferred. Infrastructure projects stalled. Finance ministers gave press conferences about fiscal constraint, and somewhere behind the cameras, 38 tons of silver changed hands. The contradiction is not accidental. It is structural. Most sovereign balance sheets, when examined through the lens of publicly reported expenditure, appear incapable of large-scale material accumulation. Debt-to-GDP ratios are at historic highs across G7 economies. Interest servicing crowds out discretionary spending. And yet, global physical silver demand, not paper demand, not ETF inflows, but actual refined metal entering industrial and strategic supply chains, has outpaced mine production for 3 consecutive years. Something is absorbing silver that does not appear in government budgets. The question is not whether this absorption is happening, the data confirms it. The question is which systems are doing the buying, and through what mechanisms they remain invisible to public accounting. This analysis will trace the architecture of that invisibility, not through speculation, but through the logic of incentive structures, the way defense procurement works, the way energy transition contracts are written, the way central bank adjacent institutions manage commodity exposure without triggering balance sheet disclosure. What emerges is not a conspiracy. It is an engineering problem. How does a system facing monetary pressure quietly convert depreciating currency into physical leverage, without triggering the very confidence crisis it is trying to insulate itself against? Consider how oxygen systems work on commercial aircraft. The masks deploy automatically when cabin pressure drops. Passengers never see the tanks. No vote is taken on whether to install them. The decision was made years earlier, embedded in engineering specifications, mandated by regulatory bodies most passengers couldn't name. The system activates before panic can organize a response. Silver, in this analysis, is functioning as a structural equivalent, not purchased in anticipation of crisis in the way a retail investor might buy coins. Absorbed in advance, inside systems that operate below the threshold of political deliberation. The accumulation is pre-authorized by procurement frameworks, not by Treasury press releases. By the time monetary pressure becomes visible to the public, the oxygen is already in the tanks. That framework, call it the pre-authorized reserve, will reappear throughout this investigation. It describes not who is buying silver, but how the buying is structured so that it never needs to surface as a political decision. Before examining what is being accumulated, it is worth establishing why the accumulation is so difficult to see. The silver market at the level most observers interact with it is a paper market. COMEX futures contracts, silver ETFs, allocated and unallocated accounts at London Bullion Market Association members. These instruments dominate the reported volumes. At peak trading days, paper silver changes hands at a ratio to physical metal that some analysts place above 100 to 1. That ratio matters less as a scandal than as a mechanism. Paper abundance creates the impression of physical abundance. When a fund manager checks the price of silver, she sees a number generated primarily by paper contract settlement, not by the movement of physical metal. The signal is structurally misleading, not because anyone is lying, but because the system was designed to price a financial instrument, not to report the physical inventory behind it. Rehypothecation deepens this opacity. A single bar of silver held in a London vault can serve as collateral for multiple financial positions simultaneously, legally distinct, practically overlapping. The same atom of silver appears on several balance sheets at once, a physical fact buried under a legal construction. When physical withdrawal requests accumulate, the divergence between paper claims and physical reality becomes measurable. That divergence has been widening. The LBMA's reported vault holdings have declined in ways that don't align with price movements that would normally reflect scarcity. Prices have remained suppressed relative to what inventory contraction would predict under a fully physical market. This is not evidence of manipulation, it is evidence that the pricing mechanism and the physical inventory mechanism have partially paper is pricing the market. Physical is leaving it. The institutional systems absorbing physical silver do not label their activity as silver acquisition. They label it as something else: defense readiness, energy, infrastructure, modernization, strategic materials, resilience. These budget categories exist in nearly every major industrial economy, and they share a structural feature. They are authorized in aggregate, not itemized for public review. A Defense Department procuring components for guided munitions systems is not required to disclose the silver content of those components when reporting to legislative oversight. The procurement is classified at the contract level or simply buried in line items that describe outcomes: missile reliability, radar sensitivity, drone endurance, rather than material inputs. The silver disappears into the description of a capability, not the composition of a supply chain. Energy transition budgets operate similarly. A government allocating capital to solar manufacturing supply chain security is functionally accumulating silver, because photovoltaic cells require it in quantities that cannot be easily substituted. The budget line says solar, the material reality says silver. The distinction is not semantic. It is the mechanism by which material accumulation escapes monetary accounting. This channel examines past system failures to understand what survives them. The pattern across case studies from post-Bretton Woods dollar restructuring to the commodity nationalizations of the 1970s is consistent. When monetary systems weaken, states redirect institutional capital into material claims. The redirection is never announced. It appears later, in retrospect, as a shift in procurement priorities that seemed unconnected to monetary policy at the time. Understanding why silver specifically is being absorbed requires moving past its monetary history. The metal's industrial properties have made it irreplaceable inside the physical infrastructure of modern power projection. Silver is the best conductor of electricity of any element. It is bacteriostatic in medical systems. In missile guidance, the switching contacts require silver because alternatives introduce failure rates that military specifications cannot tolerate. These are not preferences, they are engineering constraints. Photovoltaic solar panels consume approximately 20 grams of silver per unit. At the deployment scales now being mandated by energy transition policy across the EU, the United States, and China, annual silver demand from solar alone approaches a level that competes meaningfully with total global mine supply. Once silver is laminated into a solar cell, it is not recoverable at economically viable rates. It is functionally removed from markets. Drone manufacturing adds pressure from a different direction. Modern unmanned systems require silver in sensors, in electronic warfare components, and in the high-frequency communications systems that allow coordinated swarm operations. Military procurement of these systems has accelerated across every major defense budget since 2022. Each drone embeds silver. Each embedded gram exits the available supply. AI data centers complete the picture. The connectors, the cooling systems, the high-density circuit boards in server infrastructure. Silver's thermal and electrical properties make it difficult to displace. A hyperscale data center build-out consumes silver in quantities that aggregate meaningfully across the sector. None of these consumption channels is described publicly as silver demand, but cumulatively, they function as a permanent extraction mechanism, converting above-ground supply into embedded infrastructure at a rate that physical mining cannot easily offset. Against this structural absorption, consider what the visible market is actually doing. Retail investors purchase silver coins and bars small denomination, high-premium physical products that function primarily as psychological anchors. The coin represents ownership. The weight in the hand provides reassurance, but the quantities involved are noise relative to industrial absorption. Total global retail silver investment in a strong year represents perhaps 8 to 10% of total silver demand. The rest moves through channels that do not require a purchase decision by an individual. Exchange-traded funds occupy a middle layer. They provide exposure to silver prices without requiring physical custody. In market stress events, ETF holdings have historically contracted. Investors redeem shares. The fund sells allocated metal, prices drop. This is paper behavior, responsive to sentiment, sensitive to liquidity conditions, structurally oriented toward exit. It is the opposite of strategic accumulation. ETF flows are reactive. Defense procurement timelines are not. Currency itself fails first and most visibly. Fiat systems under pressure inflate, then fragment credibility, then require restructuring. The historical record: Weimar, Argentina's convertibility, collapse. Zimbabwe's dollarization, Venezuela's Bolivar sequence, shows a consistent pattern. Monetary instruments degrade publicly, while material holdings concentrated in state-adjacent systems preserve functional value privately. The degradation is never evenly distributed. Visibility of the failure is not the same as universality of the loss. The present configuration of silver markets contains signals that fit the pre-authorized reserve framework. COMEX registered inventories, the metal actually available for physical delivery against futures contracts, declined sharply through 2023 and 2024, even as open interest in futures remained elevated. This is the condition the paper-physical divergence framework predicts: financial exposure expanding while physical backing contracts. China's approach warrants specific attention, not as an accusation, but as a case study in institutional opacity. The People's Bank of China does not directly purchase silver on open markets in ways that would require public disclosure. What it does through state-owned enterprises, through procurement mandates embedded in 5-year industrial plans, and through financing arrangements with silver-producing nations, is create institutional demand that never appears on a central bank balance sheet. The mechanism is indirect. The effect is accumulation. JP Morgan Chase holds the largest known silver vault position of any financial institution. The mechanism by which a commercial bank accumulates that position involves client custody, derivatives, hedging, and proprietary positioning that is disclosed only in aggregate. At intervals, in forms that do not permit reconstruction of the precise timeline or counterparties, what is visible is the size, what is opaque is the structure, and what the structure obscures is who, ultimately, is the economic beneficiary of that concentrated physical holding. These are not anomalies, they are nodes, points where physical silver enters institutional custody through channels that are legally transparent but practically invisible to aggregate market surveillance. The metal arrives. The rationale is documented somewhere. The public accounting never assembles the complete picture. The framework this analysis has developed, pre-authorized reserves flowing through budget categories that describe capabilities rather than materials, produces a specific prediction about how the asymmetry between institutional and retail behavior will resolve. It will not resolve through price discovery in any conventional sense. Markets that are partially paper cannot price physical scarcity cleanly until the divergence between paper claims and physical inventory becomes acute enough to force settlement in metal rather than cash. When that inflection arrives, it will not look like a commodity rally. It will look like a procurement emergency. Defense contractors unable to source components at contract-specified prices, solar manufacturers facing allocation constraints, electronic supply chains reporting lead times that destabilize production schedules. The signal will appear first in industrial trade publications, not in financial headlines. By the time financial markets reprice, the physical metal will already have moved. This is not a prediction. It is a description of how similar divergences have resolved historically. The 1980 silver price episode, the 2011 industrial demand surge, the 2020 physical premium spike during pandemic supply chain disruption, each instance showed the same sequencing. Industrial scarcity preceded financial recognition. The system noticed the physical constraint before the price caught up. Return to the Rotterdam warehouse. The 38 tons cleared customs before dawn. The procurement subsidiary that received them is a legal entity to layers removed from the defense contractor that commissioned the purchase, which is 3 layers removed from the ministry that authorized the strategic materials budget line, which was approved in a legislative session that discussed defense readiness in aggregate, not in grams of silver per missile guidance unit. The system is not hiding anything, in the sense that each individual transaction is documented somewhere. What the system is doing is distributing the documentation across enough jurisdictions, procurement layers, and budget categories that no single point of observation can reconstruct the whole. The opacity is a feature of the architecture, not a failure of it. Debt systems are failing publicly. The press conferences happen. The ratings downgrades are reported. The yield curve inversions get analyzed on cable television. Material systems, meanwhile, are strengthening privately embedded in infrastructure budgets. Disguised as capability investment, moving through bonded warehouses at 2:47 in the morning, the oxygen was loaded into the tanks before the pressure dropped. The masks will fall when they are needed. No one in the cabin authorized the system. No one in the cabin can override it. The planning happened in a room that doesn't appear on the organizational chart, and the metal is already there, waiting. When currencies weaken, systems don't panic, they convert.